Welcome back. In this session, we're going to discuss solvency ratios. Solvency refers to a company's ability to remain in business over the long term. Solvency is related to liquidity, but differs with respect to time frame. Remember that liquidity measures the ability to pay short-term debt, whereas solvency measures the ability to stay financially healthy over the long run. We also have to note that solvency focuses on capital structure and assesses the extent of borrowing needed. Capital structure refers to the relationship between debt and stockholders' equity. So if we look at that second side of the balance sheet with the first side of the balance sheet and the accounting equation, which are assets, we're now looking at the other side of the equal sign, which takes into consideration long term, so in other words, debt, and then our capital structure focus, which is what is our capital stock and retained earnings. Okay. So the first one that we're going to take a look at is debt to equity ratio. The debt to equity ratio tells us that for every $1 of capital, remember that includes stock and retained earnings, creditors provide, depending on the year we're looking at below, either 25 cents for every dollar or 24 cents for every dollar that we raise. In this particular case, this is a very low debt to equity ratio, low, below 1. This indicates for Robin a preference to raise funds through equity financing, so in other words, to sell capital stock, and avoid the tendency for the higher risk of debt financing, which is going to a bank and borrowing money. So you can see that this is very important, not only for internal managers, but for external people to understand how Robin's Boutique is borrowing money. In this case, they tend to sell stock opposed to go to a bank for a loan. The next one we're going to take a look at is the times earned ratio. And this measures a company's ability to meet current interest payments by the creditors, specifically measuring its ability to meet current year interest payments out of current year earnings, meaning I don't have to go borrow money to pay back my loan. Both interest expense and income tax expense are added back to the net income here, because interest is deducted from net income to arrive at taxable income. This adjustment gives us a pure measure of income available to pay interest. This ratio is very important to bankers and other lenders, and obviously we know why. They want to make sure they're going to get their money back, right? And so in this particular case, we take net income, we add back the interest expense and the income tax. We then divide it by the interest expense. And so in this particular case, you see that in 2009, they were 36 to 1. So for every $1, they could pay back 36 times of their particular debt. In 2010, it went down a little bit where they can only pay 26 times to each $1 of debt. So in this particular case, the lenders would feel pretty good about loaning money to Robin's Boutique. So the next one that we want to take a look at talks about debt service coverage ratio. And the reason that we take a look at this one is because there's two major weaknesses that are associated with the ratio before, the use of the times interest earned ratio as a measure of ability to pay creditors. First, the ratio considers only interest expense. And we both know that we not only have to pay back interest, but we also, those banks and lenders, want to get back their principal. And that is a weakness in the interest times earned ratio. So management and other decision makers must also be concerned about the amount of principal that must be repaid on the current debt. Second, the ratio does not take into account any non-cash adjustments to net income that arise because of accrual accounting, like depreciation, those kinds of things. So the debt service ratio is used to know whether the amount of cash generated from operating activities is adequate to repay principal and interest in the upcoming year. These ratios for Robin show us that in 2011 that $1.61 for every $1 of interest and principal paid in the prior year, or interest and principal paid, and $3.28 for every $1 of principal paid in the current year. So this is telling us that Robin's Boutique generated $1.61 for every $1, and much, much better, almost double that in 2012, the ability to go ahead and cover their debt. And so what you do is you take cash flow from operations before interest and taxes, and then you divide it by interest and principal payments. And that gives us our debt service coverage. The other one that I'd like to go ahead and take a look at, and I believe it's the final slide in this session, is cash flow from operations to capital expenditures ratio. This ratio measures the ability of the company to use cash flow from operations to finance its acquisitions of property, plant, and equipment. Okay? In other words, whatever we really earn from operations allows us to finance buying new property, plant, and equipment. Cash paid for acquisitions is found in the investing activities section of the statement of cash flow. And I know you guys haven't done this yet. You will be doing this, but you will be able to look at example problems and be able to pull the information out. Unfortunately, I'm not sure why they do ratios before they do the cash flow statements, and I probably should look at turning that around. During the year, this amount for Robin's Boutique was $105,000 and $20,000 during the prior year. So this is what they bought equipment. Okay, this came from the investing section. These ratios tell us that in the prior year, Robin's generated cash from operations approximately 2.4 times greater than what was needed for acquisitions. So that means I made more money than I needed to buy new equipment, right? In the 2012, the ratio shows that Robin generated cash from operations to cover only 86% of the capital assets needed. So they actually would, what this would tell you is they needed to go out and borrow money. So by doing this, they don't have enough cash from operations to cover the assets they need. So they either have to borrow money or sell stock. And that's the cool thing about these ratios, is they give you the ability to look deeper than just into the numbers. And so for this particular ratio, it tells us, do I have enough money from my operations to buy the equipment, or do I need to do something else to help me buy the equipment that we need? And now let's move on to the fourth and final session.